This week our topic is on budgeting for financial control, and I've put together chapters 12 and 13 into this 1 week because chapter 12 really just provides a framework for understanding the different types of budgets, and then chapter 13 comes in and kind of fleshes it out with some examples. My presentation here is to highlight some of the more important concepts in those two chapters and provide you with some additional more relevant to education and extension types of examples. So that's how we'll proceed, and hopefully it doesn't get too long because there's a lot of information to share. It goes back in this chapter with starting with the era of accountability, and these budgets are really looking at, are you spending the money the way that you're supposed to have? Are you abiding by the legal authority that you have? Are government funds being expended the way they should be? And we hear on the news all the time about those kinds of issues, so that is something that you want to avoid. Your name on the front page of the paper or in the news as not being a good fiscal manager of the especially public funds that you have, and of course the private funds as well. People get in trouble for doing things with private funding as well. And so being as transparent as you can about the accountability procedures or the accounting procedures, and they make a distinction there between budgets and accounting. Make sure that you have those correctly sorted out in your mind. But in fact, that's my second bullet there. Budgeting and accounting are not the same thing. Your budget is the best estimate, and your accounting is actually what went on. And both will be called into question if there's some financial question about what's been done. They'll say, was this part of the budget? How did it go beyond? And then more importantly, what wasn't accounted for? But in the era of accountability, paying attention to the fiscal requirements of a program that you're running is extremely important. They talk about the purpose of budgeting, and they outline three purposes: the financial control functions, and that's where we're looking at keeping agency and program revenues, inputs in balance with agency and program expenses. That means things are in balance. That means if you're not supposed to be making a profit in your organization, that you have a nonprofit way, or that all of you are accounting for the same amount that is coming in as is going out. In other words, you're not running into the red. That gets the ire up of most accountants and also anybody who's supervising your accounts. The management purposes of budgeting deal with the utilization of agency and the program revenues, or the inputs, to maximize those efficiency or productivity, those outputs. So we have this financial control function, and then a management purpose for budgeting, and that's actually played out really well in a graphic I'll share in just a minute that's part of your text. And then there's the planning purpose of budgeting that deals with the utilization of those revenues inputs to accomplish those agency program goals. And even if you are a nonprofit and you tend to make profit, let's say you have a way of doing revenue, as long as that funding is being put back into programming, it can be considered nonprofit. And those are some details that when you actually get into a situation you'll learn about, but I'm just introducing some of those concepts to you now. Some major models for the budgetary process. They talk about three models. Incremental, where that's just an extension of previous year's budget, and we've been operating on those in state government for a very long time. If you had a budget last year, they may just say, well, we found enough, population's increased, or we've had a cost of living increase, and so everybody's going to get a 1%, or everybody's going to get a 2%. And it's just nothing's really looked at in the budget, whether it worked or didn't work. It's just business as usual, if you will, going on the previous budget. The political model, which actually also has a role to play, even if you have an incremental model sometimes, is that process of negotiation and people jockeying for position with their programming and showing that theirs has more impact. And so that in that regard, they should be getting more of the piece of the pie. And that actually also happens oftentimes when there's even that incremental model. People will try and come in with some political maneuvering to perhaps derail that and get a little bit more of what they are hoping for, because they see what they're doing as more important, or they have larger impacts on what's currently going on. So I see some of those working together. Oftentimes in state government, though, it is just a flat 1-2%. Some years here in Utah, we had some 0% in terms of raises for faculty or university higher education, and also secondary education and K-12 education. Rational planning model, that's the logical planning, and that one, obviously, you read it and you go, that makes sense. we should really be more rational about the way that we allocate the funds. We should look at the impacts. We should look at the needs. And that is not the business as usual. That is really taking a look at what's working and what needs more resources and what's maybe not working and should either end or have their resources reduced. We'd like to see this one a little bit more, and quite honestly, if you can parlay that into a political model, then you can probably get some traction for some increased funding. But they introduce you to those 3 models of the budgetary process, depending on the type of organization that you might be working for. Now, these 2 models inside of your text, really, they do a pretty good job of what's spelled out in maybe 2 or 3 paragraphs, a piece in narrative, what they're really talking about. So this financial control purposes right here. So if we take a look at this, we have the inputs, activities, outputs, and outcomes. This should look very familiar to you. This looks very much like a logic model. And so in this case, they're putting it into a bit of a financial model. We have inputs, which could be revenues, or we could have maybe it's a staff person who's being paid to do this job already. So we have some funding base that's already there. Then we have some activities, which are always going to cost us money. There's always some sort of cost in you doing something, whether it be operating, travel, copies, phone, or whatever it might be. Then we have the outputs, products, and services that you're providing. This could be through the particular intervention. These 2 sometimes get lumped in together. But activities have expenses, and outputs are the products and services that can also have a tangible dollar value. And then the outcomes, results, impacts, and accomplishments. When you're looking at financial control purposes, you are taking into account the inputs and activities. What's really happening here? This is where the bean counters are really making sure that the numbers jive between budget and what's being spent. The management purposes then are we managing these dollars? Are we really using revenues or expenses? Revenues could be from grant funds or what's being given to you as part of an annual fund from state governments or county governments. Are we really using these revenues, putting them into appropriate expenses and getting this deliverable output that goes out to hopefully provide some product or service? And that's more of a management purpose for looking at that framework of budgeting. And then planning purposes. For planning purposes, at the end of the day, with our outcomes in consideration, in play, did we have results, impacts, and accomplishments that were appropriately spent out for, that we feel like we got a return on our investment or bang for our buck, and thereby we can go back then into the budgetary process to make some adjustments, whether they be increases or reductions. Table or figure 12.2 goes a little further with this. It talks about the different major types of budgeting systems, and that's actually pretty important. And that's where we'll spend the bulk of my time here in this overview lecture of these 2 chapters. But we're looking at the program budgeting system, the planning purposes, the management purposes, and then the financial control purposes. So that was very similar to what we just saw right there. So taking a closer look at it, we see that the line item budgeting system, which is one of the systems discussed, the functional budgeting system is put into here, and that's more of a management purpose. And then the program budgeting system, or the planning purposes that you have. So having all 3 of these components might be required for what you're doing to really take a look at your outcomes. But the truth of the matter is that when you apply for any kind of funding and when the accountants are looking at it, this line item budget is probably the most crucial thing. And in fact, the line item budget, without this, you really can't do the functional budgeting system, and you can't really do the program budgeting system. Everything is built off the line item. You need these calculations to go to these other extents to figure out the types of management purposes that you might have for funding and the planning purposes. And that becomes evident in Chapter 12. They go into quite a bit of detail about this. But I want to stress the importance of everybody starts with a line item budget, and that is actually what's being requested in your proposal, and that's what granting agencies typically want. So moving on from there, Table 12.1, they lay out a line item budgeting system, and this should not look drastically different from anything that you may have learned through some financial literacy type course or even perhaps balancing your checkbook. But you have these revenues or the funds coming in, and it could be not necessarily, this is obviously a grant, the United Way. You might have a government contract and so forth. Oftentimes, these have to be accounted for separately because you don't want to commingle the funds, as it were, and not be able to report out to those funding agencies. And that becomes something that an accountant is able to track for you so that you don't have the commingling of funds and every single penny and dollar can be accounted for from that particular funding revenue stream. Then you have the expenses down here, which should look all pretty clear, except for this one here called ERE at 25%. And then there's a note down below. ERE equals the employee-related expenses. For example, income tax, withholding, Social Security, and Medicare taxes, employee and dependent health care and dental insurance, and any and all other benefits that might be attached therein are put on this ERE. And this organization is calculating that that would be about 25%. At Utah State, I'm going to show you that it's well over, I think it's at 44% or something like that. I'll pull that over in just a moment. This is actually a typical number for a local education, like a district, and even state departments of education or government. But at universities, this rate is much higher, and it has to be applied to each one of these people who is employed. Now, what they did here is they just took the total and they applied 25% to everyone. And in fact, if everybody is at 25%, then that's great and fine. It tells you what the expense is for those ERE, employee-related expenses, or what we'll call as benefits and taxes. And so that's fine there. But sometimes you have a budget where maybe these first 4 individuals fall into one rate, but then you have hourly employees that maybe fall into another rate. And so you'll hear 2 other terms, and it's noted here right above. It's this term right here, salaries and wages. So salaries are the ones that are the salaried employees. They typically have the higher rate applied to their ERE, or their employee-related expenses. And then you have the wages, and wages is usually a term used for hourly staff. And so that would be, at Utah State, that number becomes quite a bit lower. They don't get the big benefit package, such as the health care and dental kind of care insurances. So that's something to be concerned with, and I'll show you how to account for that in different columns and a couple of other examples. But the rest of it falls into line, and this is talked about in detail in Chapter 13, rent, utilities, equipment, and so forth. Rent in some contracts would not be allowed and would be considered overhead, an indirect cost. Facilities and administration, and some contracts or grants will not allow you to cover for rent, although rent is definitely an expense. So you'll just have to see how the agency you're working with categorizes all of these items. Obviously, travel and conferences are direct costs to this program, and then you can have other miscellaneous, but most organizations want you to be able to spell this out. They don't just want to see that what's in this category is what they want to know. So they have this, and the revenues here, and then the expenses here, and of course then you can see the bottom line, and hopefully you balance the budget. That's what it's meant. It means that you can have a little bit in the black, but you surely do not want to be in the red. All right, so budget expense details. The ERE, or the benefits and taxes, could be a percentage. Most often they are. I'll show you those in just a moment. Indirect costs. They mention this in Chapter 13, and they start talking about indirect costs as a pool because they are looking at an entire agency, and they decide which programs have more indirect costs. Don't get confused by that. It appears complex at your first reading, but really that's all it is saying you're taking more of all of the overhead, the facilities and administration, our rent, the square footage, the electricity, the lights, the air conditioning, the heater, than anybody else, because your program occupies more space. Your program has more people. Your program has more internet connections, whatever it might be. And so that pooled indirect cost talked about in Chapter 13 is just saying everybody should be paying their fair share based on their use. So they have the tables might look a little complex, but that's really all it is. But I want you to be very familiar with these terms: indirect costs, overhead, facilities, and administration. And be sure to note that these F&A, facilities and administration, to note that whether they are, that should be are, or that they are not covered or permitted in this, in your particular proposal. So you'll either see that F&A are allowed, or you will see that they are not allowed or not permitted within the percentage. I should have noticed I was missing a couple letters there. Let's take a look then at a couple of examples related to that. So these are the facilities. Well, let's see. Let's start with the benefit rate first. These are the Utah State University benefit rates, and they project them out so that people who are doing a proposal or a project that won't start for a year from now, or it's a multi-year project, maybe it's going to cover 5 years, you can predict out what the benefits, the ERE is going to be on each person in that area. So if you are a contract employee in 17 and 18, that's going to be 46% and 46.5% and 47% and so forth, all the way up to maybe 48%. These are just predictions. It's based on an algorithm of previous years. It's been hovering around that 40-45% for probably, I don't know, at least a decade. 46 is what they projected for this year. If it's a payroll, that 8%, that is just used to cover workman's comp, some of the taxes and Social Security kinds of taxes. That would be for your hourly. So this is your wage folks. These are your salaried folks. And then down here, if you employ students, in the case of Utah State University, this is the rate for their benefits or their ERE, and that's what you would put into your budget. Those of you who are working on a program plan that would utilize the services of, let's say you were working with a county agent, for round numbers, they're making $50,000 a year, and they're going to dedicate 10% of their time to this new program proposal. You need to figure out what 10% is of 50,000, and then take that number, 5,000, and figure out what 46% of that is, and add it to the actual cost, because you are now incurring not just the salary that they have, but the benefit package that they have as well. So all organizations have these at some level and at some negotiated percentage. And they should be published someplace that you can get access to them or be able to ask an HR person where it is. Now let's switch from the benefit rates to the facilities and administration, to the facilities and administrative or indirect costs, sometimes called overhead. I think that's pretty much capturing most of what they're called. But if you take a look then, again, these are projected out, and at Utah State for 17 to 18, this is what they're looking at in terms of organized research. So that's on campus. They're looking at about 14 or 42.6%. If it's based on research, that's the rate. If it's instruction actually has more in F&A, because oftentimes you're dealing with facilities, the physical facility. At Utah State, that might be as much as 50% on a contract. And then other sponsored activities, which might be something that's not instruction. You're not really doing specific research that's taking a lab or anything. Maybe it's just doing research that's computer-based in your office, and you can justify something that's on campus that's not taking those kinds of things. That's 26%. Of course, in county offices, they would be using these off-campuses percentages. These are easy to find. You simply just Google, and that's how I found these, F&A or indirect costs, and USU. This is like the first hit that you get. And again, this should be published for the organization that you're working with. Something to keep in mind when you're taking a look at your budgets. All right. The other thing, in-kind contributions. You could create a category or a column, if you will, for people who are going to do in-kind contributions, where they're agreeing to provide a service to you or some supplies to you because they want to see your program succeed. They don't have the ability to give you financial support, but they have product. I'm thinking of here in Logan, I needed some in-kind support for a conference, so I went to a lot of the Product of Utah people and I asked them to donate actual product like cheese and popcorn and things like that. Those do have a dollar value, and sometimes in a proposal or in a grant application, they will ask for in-kind contributions that you plan to receive. They want a monetary value on that to see that other people are contributing to your cause in some way. If it does not ask for in-kind, it's actually a lot simpler to kind of leave it out of the budget, but just mention it in the narrative that you have other supporters that will be supplying some of the products. Because sometimes if you have in-kind on there, then you have to go and look at are they also requiring, is that organization requiring a match of funding? And they are kind of, if you have an in-kind contribution, sometimes those can or can't be counted as a match. You may have seen these kinds of things. If you raise $25,000, we'll also give you $25,000, and you can't use sometimes these in-kind contributions. Just want to make you familiar yet again with another term that you'll see in the budgetary process. Allocated time for staff on programming. I already talked about this. If you are taking a staff member that already has a role where they're being paid to do something and they can have time freed up from them and be paid on this contract, then you can do that. You can say, we are going to need funds to pay for 10, 20% of this person's time, and you put that in your budget. Or you can say, we are bringing as a contribution to this project 10 to 20% of this person's time. And you can note that in two separate columns. These details are really outlined usually in a request for application or by your organization, but they do definitely impact the granting and budgeting process in this way. So say, for example, you have built this beautiful budget for a project that's going to cost $100,000. And all of a sudden you realize that you haven't put in the F&A costs that your university or your organization is requiring. And let's say it's a big chunk of change, like 44% of the total. So you multiply your $100,000 times 44, and you see that that is going to add another $44,000 to your grant request. But the grant request only allows for $100,000. Now you have to go back into the program that you've created and cut something, rerun the numbers so that your threshold of what you can ask for is under what is being allowed in a grant request. That's where things get to be a little bit interesting, because you're forced with, I won't be as effective in this intervention the way I've designed it if I have to pay these costs. So balancing that out, figuring that out, making your project small enough to still be within the budgetary constraints is really important. Same thing happens if you forget to put on those EREs. If you forget the benefit package and you just total that, you're going to be over budget, and you're going to be outside of what it is that they are willing or as part of that grant or that funding opportunity. So make sure you pay attention to these details and percentages in the totals so you know exactly what you're asking for. Some grants don't allow for F&A. They just put right in there, we will not pay for any F&A experiences. They'll pay for benefits because in reality, those are taxes and Social Security and things that really need to be paid. But they can opt out of facilities and administration, and that may or may not be honored by Utah State University or any other institution. They may say, that's okay, this fits within our role, it's not costing us tons of money, we're okay. Or they may say, no, you're using a whole lab, you're using a big office center, you're using a lot more staff support and accountants, and we have to pay those people. Because remember, in big institution, you didn't put the line items for all the, I'll call them bean counters, all the accountants, they aren't a line item. But they would be considered in F&A, and if the institution doesn't allow for that and you are needing a lot of tracking from that grant, well, that's an expense to that institution, and they may say, sorry, don't apply for these funds. It's not worth our time and effort. We are going to spend more as an institution to get these funds than we're going to get. So those are some of the details left out of this chapter that are hopefully when you become in a position and you're at that teachable moment, you'll remember some of this terminology we talked about right now, and also get some of these things inside of your budget, or at least talk about them in your budget narrative, that these costs are not allowed, or that we have considered this as part of the budget, and you put it in there so I can see that you at least thought about these items. All right, let's move on to the next one.